I would say that that probably is the number one risk that we're looking at heading into this year are the valuations, which is why we feel very important, strongly that you need to have earnings back this up. So we think earnings this year growth could be around 11%. That's pointing to, maybe a slight contraction in multiple, so it's 10% total return story on the S&P. But Carl, I'll tell you, the more things change, the more they stay the same. Last January, I was probably here. The Kansas City Chiefs were playing the AFC title game for a chance to go to the Super Bowl. And I was talking about, oh my goodness, will inflation cooperate enough for the Federal Reserve to be able to cut rates? And that's exactly what we're saying now again. And the Treasury rate is the most important thing. Volatility around rates will drive the equity market in the near term. You saw that post-December Fed. You saw that in December payroll report. And then last week, we saw that when CPI just came out a little bit better, the equity market took off. So that's the number one thing we're watching. Concentrations absolutely look very stretched right now on any measure. But these companies, NVIDIA, for example, last year, didn't have this crazy multiple expansion. They had crazy earnings growth. So you could withstand these valuations. So we're overweight stocks here, Leslie. It's not like we're saying be underweight stocks because valuations are too expensive. We believe in the E of the PE. We don't need multiple expansion to get the return this year because we think we can get it through earnings. And all of this goes back to we have the lowest probability of recession that we could possibly have over the next 12 months at 15%. We, as portfolio managers, can't take it much lower than that. There's no such thing as zero probability in any event. And I can't say enough about the U.S. consumer. 70% of the U.S. growth, all-time high in household net worth. They're still sitting on that 4% effective mortgage, which I've spoke on this before. The number one reason why we're not in recession already with these higher rates is because the U.S. consumer did a really nice job refining. So we're really positive on the U.S. consumer and the labor market, which is driving the overweight to U.S. Yeah. About concentration. We have an equal weighting in our overweight. So we're overweight stocks in a 60-40 portfolio by about 10. Half of that is in mid-cap. Half of that is in cap-weighted S&P. And I think a big part of that is the breadth story that you're referring to. If these companies simply are not worried about rising rates, rising inflation, and risk of recession, I think you can get increased breadth. Add that to the point which you've probably discussed on this show, where small business optimism, biggest 2-month jump in small business optimism in the 39-year history of the index, and then the who's who of people at the inauguration kind of standing behind the administration and getting ready to go over the next few quarters here.